For years, the crypto industry claimed there was a coordinated extra-legal effort to cut crypto off from the banking system. The media called it a conspiracy. We now call it Operation Chokepoint 2.0. A new report from the House Committee on Financial Services confirms many of those things we in crypto already knew. There was, in fact, a conspiracy to debank us. We're going to explain it. The first time we heard this phrase, Operation Chokepoint 2.0, was what, like 2023, I think, when Nick Carter published some exposés on this, and a lot of it was like conversations he'd been having with some of their with some of their clients and investment companies. And the thing is, like, when he published this, everyone in our industry was like, oh yeah, this makes sense. This has been happening. There has been debanking. We couldn't really point to why. But basically, every few months, like, new drips come out and confirm this. And this is kind of, I would say, like the capstone report, Colin, is like, this is a formal report, again, kind of from like a GOP-driven committee. But this is an actual real report with like the formal documentation of what I would call a conspiracy. It's Operation Chokepoint 2.0. So I ask you, Colin, what was 1.0?
Operation Chokepoint 1.0 was an Obama-era mandate where the Obama administration's agencies sought to systematically sever certain industries and businesses from the banking system. The ones that were targeted were coin dealers, ammunitions and guns brokers and dealers. I believe the marijuana industry and some of the adult entertainment industry, people in those industries were also targeted. And it seems like Chokepoint 2.0 was kind of the revival of this towards a completely different industry, or rather two industries, the crypto industry and some of its tech adjacent partners, right? You know, Mark Andreessen was on Joe Rogan Experience before the election talking about the debanking and how it really spread into crypto and into a bunch of different tech adjacent fields. And just a few words on how this story was broken. I think, number one, no one outside of Bitcoin or crypto is going to take an industry proponent and an industry professional like Nick Carter seriously when he writes about this, which I think is, you know, maybe from a first principle perspective, okay, it makes sense why people think that. But if you actually think deeper about the problem here, you need to ask yourselves why Nick Carter was in the position to break the story in the first place. And I think the reason for this is my gut is he's friends with a lot of the people who were affected. They were going to talk to him about this off the record, or feel like their confidentiality was going to be actually, adhered to, and Nick was actually going to respect that when releasing the story. They're not going to go to a finance journalist for this. Number one, it doesn't really fit a lot of narratives against crypto, and they would say, well, if the government's saying there's fraud, then that's the whole story. Then you shouldn't be banked, right? Whereas with someone like Nick, who's actually knows these people, knows how the plumbing works, has interacted, maybe even had some problems himself, right? He was kind of well positioned to break this. And I think when you look at how it was broken and now what's coming out now, I mean, Pirate Wires is an alt media. It definitely trad media, and people who read trad media would not look at it as a single source of truth. But chalk one up again for the conspiracy theorist, because this was 100% happening. And now we have the receipts for it. And I think that's probably the most interesting part of this, Charlie, is we can look at, like, date by date, the memos and the actions that were taken by the SEC, the FDIC, the OCC, and all of these different agencies to try to basically completely choke out banking relationships for the crypto industry.
Yeah, and I will actually, I tweeted about this right before we recorded it, and I got a little bit of chatter, and I'll actually highlight a couple tweets, because I think it'll help us get in front of a couple points early. So there's a guy named Akeem War. He's a very good critic in Bitcoin, give or take some things he says, but he's a good critic. And he says, I mean, what is this, though? Like, imagine if Dems take over the House this year and write a report saying that Trump uses power to drive woke ideology out of universities. Is that profound? I'm like, so I wouldn't be surprised to hear that. It would be a disagreement over, like, ideologically should he or shouldn't he, but I wouldn't be surprised, like, to hear that. I'd be like, Trump's kind of like, he's a strong man, and he like very much plays his sides. The thing is, I don't think many people would say that he wouldn't do that. With the OCP 2.0, it's like we felt like literal conspiracy theorists were even saying it's happening. And then another one, which is, I said, so this would be a conspiracy in the sense that there were people having off the record conversations and coordinating efforts to harm the industry, not just relying on like policy or enacting policy that we disagree with. And I would say yes. So this is both like a coordinated shadow effort to debank, despite the industry actually being compliant, or at least attempting to be compliant, because it was really murky exactly how they designed this to provide an unending maze towards compliance without actually creating regulations or any kind of MO. And I say, like, it would be better if I would consider it more fair, at least, or intellectually honest, if there were, say, an agreement at the federal level to say we do not want the crypto industry here, so therefore we're going to make it impossible to be here, as opposed to not saying it and quietly debanking people and making them feel crazy. So we have a timeline.
Yeah.
And
sorry, I want to highlight that last point. Like, the main takeaway when you read this document is that ultimately there was this regulatory carousel that you could never get off with the Biden administration, where the Biden administration and its agencies were basically saying crypto is a huge risk, but did nothing to provide clear regulations or steps that financial institutions could take to mitigate those risks. So it's kind of like saying, hey, this business that you're engaged in is a risk to your clients and your shareholders. Okay, what do we need to do outside of what we're already doing, which you said we need to be doing, and we've agreed to that? What else do we need to do? No comment, right? I mean, there were multiple times where the FDIC and other agencies said, you need to tell us before you deal with crypto clients. You need to get approval. Banks would apply for that approval, and they would hear nothing back. So with regards to the timeline, I think where to start, because this is the domino that really pushed the crypto industry into a corner and led to several bank failures. And that was starting with the office of starting with the FDIC, the Federal Deposit Insurance Corporation, sending these letters to crypto companies. Sorry, Damien, we're all over the place. Cut that. I'm trying to get my, here we go. The action seems to have started with the FDIC sending these pause letters to 24 or so financial institutions. And what these pause letters said, this campaign took place between 2022 and 2023, is it ordered banks to delay or stop crypto-related services, wait for the FDIC review for those services and those accounts before processing funds in those accounts, require dozens of written responses back and forth about this whole rigmarole. Banks were required to unearth like mountains of legal documents and financial documents, and it also included in-person supervisory visits. The reason I'm starting here, and the document might well draw a clear thread between this. I didn't see any direct quotes, but if you remember, as we've covered this on the writer's room in the past, there were 3 bank failures that were more or less forced failures because of these banking restrictions with Operation Chokepoint 2.0 in March of 2022. Those bank failures were Silvergate, Signature, and Silicon Valley Bank. So just for the quick timeline, on March 8th, 2023, Silvergate announces voluntary liquidation of its assets. March 10th, 2023, Silicon Valley Bank collapses and its funds are seized. March 12th, 2023, Signature Bank is shut down by regulators. These banking failures were basically a domino effect, a cascading effect, because a lot of these banks had accounts with each other, and they dealt in the same industry. They mostly had crypto clients. I know companies that a lot of crypto companies banked with Silicon Valley Bank, and many people in our industry were scrambling to figure out how to fill payroll in this time. And there's this one quote here that I just want to highlight from Fred Thiel, Fred Thiel, the CEO of Marathon Digital, the largest miner, depending on the time, based on hash rate. And so this is from Fred Thiel's testimony during the House committee meetings, where a lot of this was brought to light, and that this report bases a lot of its testimony on. Says, quote here from Fred Thiel: "We banked with Signature, and when the FDIC shut down shut them down, and Flagstar took over the accounts. None of the crypto accounts were allowed to be a part of those assets acquired. And we were forced to immediately seek accounts with other banks. We were able to open an account with another bank, deposited $70 million after going through the approval process. And 6 days later, we were told we had to shut down the account because our bank no longer will bank, because the bank will no longer bank crypto companies. We were basically given a policy decision by the bank that they would no longer service crypto companies, period. And we were asked to withdraw our money in what I was thinking 24 or 72 hours. So imagine that, right? Like you moved $70 million to this new bank because your old bank was shut down because of this measure, Operation Chokepoint 2.0. And then the new bank says, because of the same thing that led to that bank's failure, we cannot service you. And I want to just reiterate, the reason they couldn't service them was because ultimately regulators were giving them no choice. They were giving them no clear indication. They were saying, you can't deal with these funds until you get our approval and until these are regulatory sound. And there were no guidelines set up for that. So I think those pause notes, as far as I can, or those pause letters were kind of like the first shot across the bow. And then over the next 2 years, there's just a slew of letters and memos from these agencies that exacerbate the problem.
It's funny because Fred's story, I have a story exactly like that, except it wasn't $70 million. It was a few $1,000,000 less. But it's like, it was weird. I was like, I got literally debanked for no reason. Like, why? Is this out of nowhere? Went to a new bank, scrambled to get the money in that bank. And then after going through the approval process, they're like, oh, you can't be here either. And the same thing. It was wild. And it was like very difficult to explain to friends and family that this was a very strange to me. And I've had other companies with other normal bank accounts. And so it's very difficult to explain to people that I wasn't scamming anything. That they're like, why can't you just get a bank account? I'm like, I don't know why. I have no why. I can't figure out why. And so a lot of people in our industry are having these exact same experiences. And Fred's story is just one of many. It just happens to be recorded in a testimonial format on the house floor.
Yeah. And what's crazy about this is this has been a problem since crypto businesses have been of any consequence and have actually, once they started scaling, 10 years ago and actually getting decent revenues, building their businesses, hiring out people, a lot of them still to this day bank in stablecoin because of these problems. And what's interesting about this to me, and we'll get into the history here in a second, is in his first administration, the Trump presidency and his agencies actually did a little bit of work to try to increase regulatory clarity and let banks deal in digital asset customers without these threats of having, funds frozen or being told that they can't deal with these customers. And the Biden administration rolled those back. So there was like this small window in 2016 to 2020 where like the banking relationships in crypto were actually like, it seemed like they were on the up and up. People were a little bit, they were a little more relaxed about their ability to actually be banked. And obviously all that went out the window. But going back to the timeline, going back to a date in 2022, on August 16th, the Federal Reserve gets involved and releases the supervisory letter SR 226. This letter warned that digital asset activities pose risks to, quote, safety and soundness, consumer protection, and financial stability. All the buzzwords that the boomers love to hear if you want to scare them away from an asset that's making all of their children have any sort of shot at the life they did. Anyway, this required banks to ensure digital asset activities were legally permissible. Now, this goes back to the kind of catch-22 that banks were dealing with. What is legally legally permissible? Because there are anti-money laundering laws on the banks that these banks on the books that these banks are already following. Blacklisted addresses, I'm sure, going through a scan. Like there are anti-money laundering and compliance tools in place. And they're following those, but they're being told they need to do more without being directly told what that is. They're told from this letter they need to analyze both state and federal law. I would be very shocked if they weren't doing that already. These are banks. They're not fly-by-night payday loan lenders, right? And the last thing is they have to notify the Fed before engaging in digital asset activities. This is the one that just absolutely sends me. Because I don't know in terms of broad reaching banking regulations, but in what world does a bank need to notify the Fed when they're banking any other client for any other reason?
Yeah.
Right. Unless I can't really think of a situation, because if there's something to do with fraud or tax evasion, that's for the IRS anyway, or at least for tax evasion. So I think that was another one of the big ones. Once you have the Federal Reserve stepping in like this, kind of the emperor's has no clothes and now his skin is peeled off, because it kind of shows exactly where their head's at. They would just want this entire industry gone because it threatens the model that the US dollar system runs on.
Yeah. So, as you kind of go through the timeline, I will then reinforce by saying, by using this format. Here's a conspiracy that we had, and then here's where the conspiracy, according to the report, which is verified in real, hard, letters, is verified. So, conspiracy theory. The shadow ban was real. The banks were privately told by regulators to drop crypto clients, even if the clients are fully compliant. We verified that the FDIC sent pause letters to effectively stop or delay digital asset activities. And more specifically, the report says that regulators used informal guidance and threats of enforcement rather than actual rulemaking. So this traps the banks in a regulatory purgatory with their crypto clients, specifically from the executive summary on the page 1. Regulators use this discretion to exert substantial pressure on financial institutions, often through informal guidance such as interagency statements or interpretive letters, to discourage these entities from engaging in digital asset-related activities. In addition to informal guidance, regulators weaponized enforcement actions to achieve an anti-digital asset agenda. So rather than this being actually defined anywhere in any kind of regulatory guidance, it is implemented with informal guidance and threats to the bank. So that's the conspiracy that we suspected, but we had not. Now it is validated in the report.
I think that's, again, just going back to all the wonderful color and commentary there, Charlie. It's a really important point to make. You expect to have laws on the books that clearly spell these things out, or clear regulations. And the way in which this was prosecuted, it was prosecuted through these letters sent to the financial institutions and kind of under the table tactics that really speak to, I think, what a lot of the problems libertarian and conservative types have with the expansion of the federal bureaucracy since the New Deal, right? But going back to the timeline, so echoing what the Federal Reserve did, or rather the Federal Reserve echoing what the FDIC does here, because this happened before the Federal Reserve's letter. But in April 2022, Federal Reserve's letter that we just touched on came out in August 2022. In April 2022, the FDIC sent out a financial institution letter that basically said the same thing as the Fed letter. It said you are required to get FDIC it requires all FDIC supervised banks to notify the FDIC before engaging in crypto custody, payments, and related services for Bitcoin companies and crypto companies, using all of the justifications of fraud, etc., that they've used for scare tactics in the past for this. Now, what's interesting about this too is that precludes crypto custody, right? Well, the Trump administration actually, or rather, Trump era appointees in 2021, in the OCC, or the Office of the Comptroller in the Office of the Comptroller of the Currency, basically issued a mandate saying crypto custody is allowed, stablecoin reserve deposits are allowed, blockchain and stablecoin payments are allowed within the traditional financial system. So this is a complete rollback of prior guidance from a prior administration. And you'll see that throughout these documents, that the Biden administration is rolling back things that have been done prior, not uncommon in presidencies. But, obviously for the crypto industry, a huge shock after coming from a generally favorable regulatory and
yeah. And I'll say that there's a difference between, I might be showing my naivete here, but there's a difference between rolling back guidance, which is fine, I just disagree with it, and doing it in a way where our industry does not know that has happened.
Right.
So...
Right. And when the Biden administration reversed this in 2022, they issued a clarification on that letter on IL 1179, which was previously issued in the Trump administration, which banks must receive non-objection before engaging in cryptocurrency activities. barred any crypto activity prior to supervisory approval, and shifted the legality standard to subjective examiner satisfaction rather than a more objective metric. Multiple national trust bank charters stalled as a result, and this effectively reintroduced permission-based banking for a specific industry. I think that's really the important point here. It's like kind of showing the exact use case of Bitcoin by saying the traditional financial system is walling you off and asking for permission. Obviously, Bitcoin does not. A few more timeline things in the Biden administration. On March 9th, 2022, right in the middle of these cascading bank failures, right? I mean, if y'all recall, we just talked about how Silvergate, I believe, was the first to fail on March 8th. March 8th, Silvergate announces voluntary liquidation. So on March 9th, the Biden administration, in all of their infinite reactionary wisdom, says it issues an executive order warning of financial stability risk regarding crypto, illicit finance risk, and directed agencies to expand enforcement instead of rulemaking. So this is kind of the gloves off moment. And when things start really accelerating, those three banks that we mentioned were used as the sacrificial lambs to say, see, this is super dangerous and we need to get this under control. And then from there on out, you have a number of the letters and actions that we just went through over the next 2 years. The document also spends quite a lot of time talking about the SEC and all of the things that it did or didn't do, rather, to foster innovation and regulation within the cryptocurrency space. We won't go over those, but it's the TLDR is like under Gary Gensler, there was this policy of basically creating policy by enforcement instead of enforcing policy. And it led to a number of, stalemates within the crypto ecosystem for a number of, DeFi applications and certain tokenized use cases. Whether or not you agree those exist, if you're doing things by the book, there's no reason why you shouldn't be able to list those in the US.
We're going to enforce things. We're going to do things by the book, and then the book does not exist, so we cannot reference it. This is one where I think even some of those hardcore Bitcoiners do line shields up with entities like Hayden Adams over Uniswap, or even some of our mortal enemies, Brad Garlinghouse over at Ripple. Like, Ripple fought this tooth and nail and won in the federal courts. And at some level, as much as I just cannot stand Ripple, I was cheering because this was a victory for our industry. Even if it was Ripple enjoying the spoils of that the most. I'll go back to my format of conspiracy theory and then validation. So conspiracy theory. Reputational risk was weaponized. Regulators used vague terms like reputational risk to force banks to drop legal but politically disfavored entities. This is verified in the report on page 7. As the report confirms that regulators use reputational risk assessments to pressure banks. If a bank did not drop a crypto client, they faced threats of lower CAMELS ratings, which are safety and soundness scores, which could cripple their ability to do business. That's one of several ways that this soft shadow reputational risk is weaponized. And then also it was coordinated. So it's the Fed, the FDIC, and OCC who were working together. So it wasn't this kind of individual department thing. It was multiple departments across the across the bureaucratic apparatus. There's talk of like policy sprints that the Biden administration used to align internal strategies. And then when Congress began to draft their actual legislation, like the stablecoin bill we saw finally get through recently, these agencies ramped up their ability to choke the industry before the laws could be passed. On page 27, in fact, this goes into detail, where in one email, a Department of Treasury employee wrote to staffers of the FDIC, Federal Reserve, CFPB, and the SEC, and the CFTC in advance of a meeting the following day. I want to flag that in light of the fact that we've all recently received text from the House Financial Services Committee, staff developments in Congress, that the committee's interests will be likely a bigger part of the discussion than previously anticipated. So these are emails and not like papered up, regulations that people are going to follow. So that's my addition to, we had these conspiracies and now we're like, okay, the docs are coming out, the emails. Oh man, it's always somebody's emails being released, isn't it?
just because Chokepoint 2.0 is over doesn't necessarily mean that banks are your friends, guys. So this is Jack Mallers, a tweet from him recently. I'm going to get it up on the screen for those following along on video, where he says, and I quote, "Yes, a proud moment. So proud I got it framed." And this is a letter from JP Morgan Chase Bank, informing Jack Mallers that they are closing his account for the same reasons that banks were restricted from using Bitcoin during Chokepoint 2.0, for vague reasons of fraud, all that kind of stuff. So the reason why I pull this up is like, I want to be very optimistic about Chokepoint 2.0 being over and this being made of a big show, this kind of like what was a witch hunt or perceived as a witch hunt actually having real smoke there and real fire. I want to just contextualize that with the fact that at the end of the day, the government is one enemy, and like quite frankly, the banks and the insurance financial system are the other enemy. And just because the government is not forcing banks to close these accounts now doesn't mean the banks won't do it, because they can do whatever they want. They don't have to bank you if they don't want to.
Yeah, I'll echo that. You know, it's very much not over. It's just the heat, the initial heat, and the initial salvo is probably over. Now it's a little more complicated because we have to figure out what is still happening, to what degree, who's behind it, and we're not conspiracy theorists anymore. The battle is being fought a little bit more out in the open, it seems, which at least we've won that battle. So I'm certain that our industry, which I think reactionarily, very reactively, supported Trump and raised some of the biggest money ever towards a campaign for that single issue pack that we had, the crypto pack. I think our industry will probably have some reckoning ahead of us for the mass that we tied ourselves to under this current administration. So for the time being, we'll at least celebrate that we're not getting debanked as quickly and as rapidly, and it's a little more clear how to conduct business in the United States. And it appears that the existential risk that we feared, which was the end of the crypto industry in the United States, is not the near-term future. So we will see where we go. If you like this kind of podcast, if you like more conspiracy theories, make sure to like and subscribe to Blockspace Podcast, where Colin and I hit conspiracies and more. So make sure to leave us a review if you like it, and if you hate it, also drop that review. We'll try to get better. So thank you so much. Catch you all next week.